Hello and welcome back to the Insurance Guru. My name is Ayanda Malele and I am here to give you some more insights and education and advice and everything else that has to do with insurance, specifically short-term insurance. So the one issue that I wanted to discuss today, which is more of a lesson in terms of what is an insurable risk, what risk can we insure and what risk can we not insure? So there are different types of risks, right? You know, I'm sure you've heard of things like a fundamental risk. You've heard of a thing like a pure risk, a speculative risk. And that basically is, you know, different types of risks that a person is, how do I put this? A person may be faced with. So I want to start with something called a specific risk. So a specific risk is a risk that is specific to either one individual or a small group of people, but it will never be or affect a larger number of people. So specific risks, for instance, is cover for your car. Your car is you specifically covering your own vehicle. Specific risk could be, you know, a big multinational with a building in Sandton that insures the building and insures liability for, you know, people that come into the building and their staff, etc. As much as it's a large-scale business, but the risk is still specific because it only pertains to them. So this type of risk is insurable. It's very easy to insure because we can actually put numbers and, you know, say this is what, how much worst case scenario can be lost in this situation. And so it is insurable. Then there is another type of risk called a fundamental risk. Now, a fundamental risk is a risk that affects a large number of people, and usually it's unquantifiable and we can never sort of see just how much or the magnitude of a fundamental risk. So I mean, a fundamental risk would be things like war. If somebody came and, you know, put a nuclear war in a country, that is a fundamental risk where now insurers can't insure that risk because we don't know how long the war will last for. We don't know how many towns will be damaged. Like there is actually, it's very hard to fundamental risks are just uninsurable because it's things that we cannot quantify. And if you can't quantify something, then you can't actually be able to cover it because what are you charging the premium based on? You know, a worst case scenario, everyone will be paying a high amount of money for that worst case scenario, which may or may not happen sometimes. So that is now the fundamental risk. And then you also have what we call a speculative risk. So speculative risk is a risk that is not also insurable, because speculative risk is where you either can suffer a loss, not suffer a loss, or gain something out of it. So when you look at speculative risks, for instance, it's when you are investing in, I'm not very good in these things, but you're investing in some stocks somewhere. And, you know, obviously if you invest in it, you could lose the money or you could actually make a profit, or you won't lose your money or capital that you invested. You literally just, it stays the same. So that risk can't be insurable because a person sort of chooses to put themselves at that risk, because I choose to take my money out to, you know, invest in these shares or in this pyramid scheme or whatever it is, because I could either lose or gain, or I could stay the same. So that is now a speculative risk. Then we have a pure risk. A pure risk is the opposite of speculative, because a pure risk is what is insurable, and pure risk meaning that, you know, it's either you can suffer a loss or you won't suffer a loss. So you can go to work today and have an accident, or you can go to work today and not have an accident. See, it's basic, and that risk is insurable because it's, you know, it's either you have it or you don't. It's not you need to be enriched or, how do I put this, but get more out of the risk itself. The risk is either your car will crash or it won't. Your car will get stolen or it won't. Not your car will get stolen or it won't, or you'll get another car, because then you're in some funky pyramid scheme thing there. But so that's basically a pure risk in short, is that it's the total opposite of a speculative risk, and that is why we can insure it. So as you start looking at all these different types of risks that I've explained, you start seeing a pattern that, okay, obviously there's some things that can't be insured, and obviously there's some things that can be insured, you know. And now when an insurer says we can't cover that, then you can be like, oh yeah, because it's this kind of a risk, and then so when you look at different types of risks, I've just discussed a few that are pertaining to the current situation as well. I wanted to discuss that, but off record or in another video about what's happening with COVID-19. So for now, that is a quick lesson on different types of risks, and I hope that you will stay tuned, and I hope that you'll subscribe to my channel and also ask me what things you'd like me to discuss and topics that you'd like me to discuss, and then we can have more conversations and more chats. The next video, I'm going to be discussing the subject about COVID-19, because now that you understand the different type of risks, it was very interesting what was happening in the media with insurance companies and claims, because I felt a different way. And I mean, this is not me advising or saying who's wrong or right. This is just merely my opinion. So if you want that opinion, stay tuned, and I'll catch you on the flip side.